How do securities markets operate globally? This video delves into the regulation of security trading and new issues in world markets. Uncover the intricacies of securities transactions and the globalization of securities markets. Securities markets are categorized into money markets and capital markets. Money markets deal with short-term securities. Capital markets handle long-term securities like stocks and bonds. The primary market involves new securities sold to the public. The secondary market is where issued securities are traded. The initial public offering, or IPO, marks a company's first public stock sale. SEC approval is mandatory for IPOs. Public offerings sell a set number of shares at a specific price. Rights offerings allow existing stockholders to buy new shares. Private placements are not registered with the SEC. Underwriting is crucial in promoting and selling company shares. A prospectus outlines the issue and issuer details. The red herring is a preliminary prospectus. During the quiet period, companies limit public statements. Roadshows present investment opportunities to potential investors. Investment bankers underwrite issues, buying securities at a set price. An underwriting syndicate shares the financial risk. The selling group assists in public sales. Tombstones announce the issue and participants. Bankers earn compensation through discounts on securities sales. Secondary markets trade securities post-issuance. They provide liquidity and continuous pricing. Securities exchanges bring buyers and sellers together. The Nasdaq uses electronic platforms for trades. Over-the-counter markets involve smaller, unlisted securities. Broker markets include national and regional exchanges. The New York Stock Exchange is a notable broker market. Dealer markets, like Nasdaq, involve market makers. Brokers facilitate trades between buyers and sellers. Dealers trade on their own behalf with market makers. The New York Stock Exchange lists over 2,700 companies. Strict listing policies ensure quality. Regional stock exchanges have lenient requirements. Options exchanges allow trading of options. Futures exchanges focus on financial futures. Dealer markets lack centralized trading floors. Market makers link through telecommunications. The Nasdaq lists both large and small companies. OTC Bulletin Board lists smaller companies. OTC pink sheets are risky with minimal liquidity. The third market involves non-exchange market makers. Institutional investors benefit from reduced costs. The fourth market allows direct dealings between investors. Electronic communications networks enable direct trading. ECNs are effective for high-volume securities. Bull markets feature rising prices and optimism. Economic growth and government stimulus drive them. Bear markets see falling prices and pessimism. Economic slowdowns and government restraint are common. Understanding these conditions is vital for investors. Diversification increases returns and reduces risks. International securities improve diversification. They offer opportunities in expanding economies. Foreign securities markets can yield high returns. However, they are often riskier than U.S. markets. Indirect investments include U.S.-based multinationals. Direct investments involve foreign stock exchanges. American depository receipts represent foreign stocks. These strategies enhance portfolio diversification. They also expose investors to currency risks. Investment risks apply globally. Unstable governments pose additional risks. Different laws and economic conditions affect investments. Currency exchange rates fluctuate. These factors influence foreign investment values. U.S. exchanges operate from 9:30 to 4. Extended hours allow more trading opportunities. NYSE and NASDAQ have specific extended hours. Regional exchanges offer after-hour sessions. Orders match only with identical opposing orders. Insider trading involves non-public information. Blue sky laws regulate securities sellers. The Securities Act of 1933 requires full disclosure. The Securities Act of 1934 established the SEC. These laws protect investors and ensure transparency. The Maloney Act allowed self-regulation through associations. The Investment Company Act created mutual funds. The Investment Advisors Act required advisor disclosure. The Insider Trading Act prohibited non-public trading. Sarbanes-Oxley tightened accounting guidelines. Investors buy and hold securities long-term. The goal is to buy low and sell high. Profits arise when prices increase. This strategy suits those confident in market growth. It is a fundamental investment approach. Margin trading uses borrowed funds for purchases. Owned securities serve as collateral. The Federal Reserve Board sets margin requirements. This method offers financial leverage. However, it also magnifies losses and incurs interest expenses. Short selling involves selling borrowed securities. The aim is to sell high and buy low. Profits occur when stock prices decrease. This strategy carries unlimited risks. Investors must buy back shares if prices rise. Short selling can profit from declining prices. It offers limited return opportunities. Risks are unlimited if prices increase. Dividends are not earned by short sellers. Understanding these factors is crucial for investors. In conclusion, understanding the regulation of security trading and new issues in world markets is essential for ensuring transparency, fairness, and investor confidence in global financial systems. Regulatory frameworks help protect investors, prevent market manipulation, and maintain stability across international markets. By keeping up to date with evolving regulations and emerging trends, such as digital assets and sustainable investing, professionals can make informed decisions and adapt to global market changes. A strong understanding of market regulation supports ethical practices and contributes to the integrity and efficiency of the investment industry. Thank you for watching this video. If you have any questions, please feel free to contact us via email or WhatsApp at 07,484,361,688.